Hi guys, welcome to accounting. Today I want to do a review of what we have been learning the last little bit on chapter 3 and a little bit from chapter 2. I want to refresh your memory on T accounts and what debits and credits mean and how they work with each part of the accounting equation. You know, we have the accounting equation assets equals liabilities plus owner's equity, or it's also called capital. So different accounts work different ways. And I know we have worked with this in the past, but it doesn't hurt to review anytime. So let's look at this. Let's look at assets. Remember, assets are anything of value that a company owns, like a car or equipment, a computer. And they are, if you look at the T account, and even not just the T account, but think of how we were working with journals right before Christmas. You have the left side of the T account is the debit side, and the right side is called the credit side. And remember, debit just means left, and credit just means right. It doesn't necessarily mean an increase or a decrease, but it will depending on the account you have. So, let's look at assets. Remember, they are something of value that a company owns, and they are increased with debits or on the left side of the T account. And in the journal also, remember the journal has a debit column and a credit column. So you are going to increase an asset with a debit, and you are going to decrease it with a credit. And remember, a normal balance side is the side that increases. So assets have a normal debit balance. Okay, let's look at liabilities. Liabilities are on the other side of the equation. And remember, liabilities are debt of the company. That is something that the company owes. For example, a car would be an asset, but the car payment would be a liability because that's something that you owe. It's a debt that the company owes. So liabilities have a normal credit balance. So they are going to increase with credit. So if you were increasing, you would enter it on the right side of the T account. And because they increase with credits, they have a normal credit balance. Now, the next side is capital account, or you've also seen it called owner's equity, and it has a normal credit balance. It increases with credits, and it decreases with debits. So remember that for capital, or it's also called owner's equity. Now on the other side, you have the drawing account. Remember, if the owner withdraws anything for personal use, it runs through a drawing account. So a drawing account is called a contra account because it works against the capital account because it's drawing down the amount of ownership that the owner has. But it has a normal debit balance because it's a contra account. It's backwards from what the capital account would be. So it has a normal debit balance, and it increases with a debit, and it decreases with a credit. Now, remember, if the owner withdraws money to use for personal use, you would debit drawing and you would credit cash because you're going to credit an asset because you're reducing it. So just remember what happens. Think of what is happening in the transaction before you think about is it debited or credited, and think of the normal, how it increases and decreases. Now the next set of accounts that you have are revenue accounts. And the revenue accounts, remember, that is any kind of income for the business. A sale, a fee income, a commission, anything like that. And it's going to have a normal credit balance, so it increases on the credit side. it decreases on the debit side. So, for example, if you have a transaction where you received cash for commission, you would debit cash and you would credit revenue because you want to increase both of them. So revenue would increase. You credit a revenue to increase it. And then the other set of accounts that we have are expenses. And expenses are any type of account any kind of expense that you incur in the running of the business. For example, salary expense, rent expense, utilities expense, and so on. Now, when you set up your expense accounts, you always want to name them. You don't just want to call them expense. So you want to have like a rent expense or salary expense or a utility expense account so you can track them. So expenses increase on the debit side and they decrease on the credit side. And because they increase with debits, they have a normal debit balance. So this kind of reviews every type of account that we have seen so far in accounting. You have assets, liabilities, capital, or it's also called owner's equity, a drawing account, that is a contra account of the capital account. Now, one thing I will tell you about drawing, we haven't always used a drawing. Sometimes we use the capital account. So that's okay too. But if your drawing account has been provided for you in your problem, then you need to use the drawing account. And then we also have revenues and expenses. Now, remember, revenue and expenses show up on an income statement. And your assets, liabilities, and capital and drawing, capital, show up on the balance sheet. Then the capital account and the drawing account, plus your net income or net loss from this, shows up on your statement of owner's equity. And we'll be revisiting those in the near future. In today's assignment, I titled it Refresh and Review. What you're going to learn today, you're going to review the rules of debits and credits as applied to assets, liabilities, owner's equity, revenue, and expense accounts, which is what we just reviewed. And you also have the joining the pieces in your module today. And you can see we've looked at this before, and it goes over the total, total debits have to equal total credits. And this kind of goes over just what we reviewed a minute ago. But this is in your module. Another piece of reference that you have in your module, in addition to the textbook that you have a summary of what debits are and what credits are. So in today's assignment, you're going to have a review sheet here on accounting terms. Now you've done this before. This was just something that I thought would be a good thing to go over before we start into anything new, since we've had a 2-week break for the holidays. But you have accounting terms review, and you're going to match the description with the best answer. And you can use these terms more than one time. You have increase, decrease, asset, liability, capital, revenue, expense, debit, and credit. And then you have a list of questions here, and it's basically just fill in the blank. For example, a debit to a revenue will blank the revenue account. So what effect will it have on the revenue if you are going to debit it? You can go back and use the review sheets in your module. You can look in your textbook that's also in your module, or we just reviewed it earlier in this video. So you are going to be doing a text entry for all of these. You can just make a list, a number of 1 through 29, and then you can just put the names of all of these. You don't have to write the whole thing out. Just put the name in the corresponding area. And always, if you have questions, feel free to ask me. I'm always available via email and via text.